Welcome to the deep dive.
Good to be here.
So today we're tackling something a bit different. There's this Motley Fool article that came out recently,
Oh, yeah.
and it picks out 3 energy stocks, calls them no-brainer buys if you've got, say, $500 ready to invest right now.
No-brainer, huh? Always a bold claim in investing.
Exactly. So, our mission today isn't just to repeat what they said. We want to actually unpack the arguments for these 3 ExxonMobil Enterprise Products Partners and Cameco.
Right. Dig into the why. Why these specific companies? Why now?
Yeah, look at the reasoning, see if it holds water. We're using that article, the one from April 26th, 3 no-brainer energy stocks to buy with $500 right now as our our launch pad.
Makes sense. Get beyond the headline, understand the real thesis behind each pick in today's energy scene. That's the goal.
Okay, let's jump right in. First up, ExxonMobil. Huge name, obviously. The article seems to think they're set to benefit from some big trends in the U.S.
Yeah, the core idea is that U.S. energy demand is climbing. Think about AI data centers needing tons of power, plus this push for more domestic manufacturing.
Right, those are energy hogs.
Definitely.
Yeah.
And ExxonMobil being this massive integrated player involved in, well, pretty much the whole oil and gas chain, they're seen as being in a prime spot to meet that demand.
Okay, integrated. You hear that term a lot with the oil majors. For someone maybe less familiar, what does that actually mean for Exxon, and why is it such a plus, according to the article?
So think of it this way. They're not just drilling for oil, right? That's upstream, and they're not just refining it into gasoline downstream. They do like everything in between, too.
A pipeline, so to speak.
Exactly. Exploration, production, transport, refining, selling. And the big advantage is it helps cushion them against volatile oil prices. If crude prices tank, maybe their refining side does better, or vice versa.
Ah, okay. So it provides a bit of a buffer within their own operations. That makes sense in a sector that swings so much.
Precisely. It's about managing risk across the value chain.
The article also really emphasized their dividend history, 42 years of increases. That's quite a streak.
It really is. The yield itself, around 3.6% currently, that's decent. But
Yeah.
it's that consistency, 42 straight years of raising the payout that speaks volumes.
So just stability, right? Through thick and thin.
Yeah, it signals a real commitment to shareholders and the kind of financial strength needed to keep bumping up that dividend, regardless of the economic weather. Tells a story.
Absolutely. It's more than just today's yield. It's that long-term pattern. Okay, so where is all this production growth coming from? The article mentioned one area in particular.
The Permian Basin, that's the big one they highlighted over in West Texas and New Mexico.
Right.
ExxonMobil's really ramped up operations there.
Oh.
And partly because of that, their overall production hit its highest point in like a decade last year, something around 4.3 million barrels of oil equivalent per day.
Wow, okay. So they're not just positioned for demand, they're actively boosting supply.
Correct, they're scaling up.
But, okay, the elephant in the room, the energy transition, climate change. Does the article touch on how ExxonMobil is handling the shift towards cleaner energy?
It does, yeah. It mentions a pretty significant investment, $30 billion over the next 5 years, specifically for lower emission technologies.
$30 billion, that sounds like a lot.
It is a big number. And they're apparently eyeing this huge long-term market, maybe $4 trillion, in things like carbon capture and storage. So it shows they're, looking beyond just fossil fuels, aiming to participate in these newer areas.
Okay, but let's be critical for a second. $30 billion over 5 years. How does that compare to their total spending? And how real is this carbon capture tech at the scale they need?
That's the key question, isn't it? While $30 billion isn't small change, you do have to compare it to their overall capital expenditures. It's still a relatively modest slice of the pie. And you're right about the tech. Large-scale, cost-effective carbon capture. It's still, largely unproven commercially. Getting a big piece of that potential $4 trillion market, that's definitely a long shot. Lots of uncertainty there.
Right. So the no-brainer part for Exxon seems more tied to the present, the demand, the dividends, while the future-proofing part is still kind of developing.
That seems like a fair summary of the article's angle, yeah.
Okay, let's move to the second stock. Enterprise Products Partners. EPD. Not maybe a household name like Exxon. What's the core story here?
With Enterprise, the focus shifts completely. It's all about the infrastructure, the plumbing of the energy system.
The midstream.
Exactly, midstream. As U.S. energy production keeps growing, oil, natural gas, NGLs, all that stuff, it needs to get moved around. From the wellhead to the refinery to the export terminal.
And that's where Enterprise comes in.
Yep. They operate this huge network of pipelines. something like over 50,000 miles. Plus, storage facilities, processing plants. They essentially charge fees to move and process these energy products.
The article called them toll booths of the energy world, which I liked.
It's a good analogy. Their role is vital, connecting the producers, upstream, with the refiners and consumers, downstream.
And why does the article see this as such a stable investment compared to, say, a producer like Exxon?
It mostly comes down to their business model. They generally get paid based on the volume of stuff moving through their pipes, not the price of that stuff.
Fee-based.
Right. And often these fees are locked in with long-term contracts. This creates much more predictable cash flow, much less exposure to the wild swings in oil and gas prices day to day.
Okay, those long-term contracts sound key. How exactly do they provide that stability the article mentions?
Well, they basically guarantee enterprise a certain amount of revenue for years to come, assuming the volumes hold up. It gives them and investors really good visibility into future earnings. Less guesswork involved.
Predictability is definitely attractive in this sector. Are they just sitting on their existing pipes, or are they building more?
No, they're expanding. The article points out they have about $7.6 billion in new projects under construction right now.
Wow.
And a lot of that focus seems to be on natural gas liquids, or NGLs, things like propane, ethane. That suggests they see strong growth prospects in that part of the market.
Interesting. The piece also mentions something about potential deregulation, opening up more land for drilling. How might that benefit a company like Enterprise?
Well, the logic is pretty straightforward. If regulations ease up and more drilling happens, you'd expect more oil and gas production.
Stands to reason.
And all that new production needs transport. So it could drive more business for pipelines, potentially leading to higher volumes, maybe even new pipeline projects for companies like Enterprise. More supply needing more infrastructure.
Kind of a rising tide lifting the pipeline boats, potentially. And like Exxon, dividends seem to be a big part of the story for Enterprise, too. Even higher, I think.
That's right. The article mentioned a current yield around 6.8% for Enterprise.
Yeah.
It's pretty substantial.
Yeah, that's high.
And they also have a long track record, 26 years straight, of increasing their payouts. So it's not just a high yield today, but one that has consistently grown.
Okay, so for Enterprise, the no-brainer case seems built on their essential midstream role, the stable fee-based contracts, growth projects in the works, maybe a boost from deregulation, and that really attractive dividend.
Exactly. It's a bet on the movement of energy, less so on the commodity price itself.
Gotcha. A different flavor of energy investing. Okay, third and final pick, Cameco Corporation. Symbol CCJ. This one takes us in a completely different direction, right?
Totally different. Cameco is all about uranium, which means it's a play on nuclear energy.
Nuclear, right.
The core argument is that there's this growing global momentum behind nuclear power as a reliable, low-carbon energy source.
Mm-hmm.
Countries need power. They want to reduce emissions. Nuclear is back on the table in a big way.
We have been hearing more about a potential nuclear renaissance. The article mentions some kind of global pledge.
Yeah, the declaration to triple nuclear energy by 2050. A significant number of countries have signed on to that. It's a major commitment.
Tripling by 2050, wow.
And what adds credibility, according to the article, is support from big financial players. Bank of America, Goldman Sachs, CITES. They seem to be buying into the nuclear growth story, too.
That level of global and financial backing does make it seem more concrete. So how does Cameco fit into this? What makes them positioned to benefit?
Well, Cameco is one of the world's biggest uranium producers. They have key assets, like a big stake, 40%, in a major uranium operation in Kazakhstan, which is like the Saudi Arabia of uranium.
Okay.
They also co-own 49% of Westinghouse, a huge name in nuclear plant technology and services. Plus, they have mines in Canada, a big refinery in Ontario. They're involved across the fuel cycle.
So geographically diverse and involved in more than just digging uranium out of the ground.
Right. And production-wise, they put out about 23.4 million pounds of uranium last year, according to the article. They're a major supplier.
The article also made a point about their contracted sales. Why is that significant for Cameco?
It's similar to the Enterprise situation, actually. Having a lot of your future production already sold under long-term contracts, the article said an average of 29 million pounds a year through 2029 for Cameco gives them revenue certainty.
Reduces exposure to the spot market price.
Exactly. The spot price for uranium can be volatile. These contracts log in prices and volumes, providing a more stable financial foundation. They know who's buying a good chunk of their output for years ahead.
Makes sense. Now, the article also noted the stock price was down quite a bit from its high. Why frame that as a positive?
The thinking is, if you believe in this long-term nuclear growth story, seeing the stock down about 33% from its 52-week high might represent a buying opportunity.
An attractive entry point, potentially.
Potentially, yeah. The idea is you might be getting in at a lower price before the market fully prices in that expected growth in nuclear demand, assuming that growth materializes as predicted.
Okay, so the no-brainer case for Cameco hinges on this global nuclear push, their strong market position and assets, the stability from long-term contracts, and maybe a currently attractive valuation. It's a very focused bet.
Very much so. A specific bet on nuclear's future role in the energy mix.
Right. So we've looked at all three now, ExxonMobil, Enterprise, Cameco, through the lens of this specific article. Stepping back, what are the kind of key takeaways when you look at them together?
Well, it's interesting how they represent three really distinct angles on energy investing, isn't it?
Yeah, definitely.
You've got Exxon, sort of the diversified giant, playing in traditional oil and gas, but also dipping a toe into low-carbon tech, plus that solid dividend history.
The legacy player adapting, maybe?
Then Enterprise focused purely on the essential midstream infrastructure, offering that fee-based stability at a high yield, the energy toll booth.
Betting on volume, not price.
And finally, Cameco, a direct play on a specific growth trend, the potential resurgence of global nuclear power.
Three very different bets under the energy umbrella.
Exactly. And it's crucial, like you said up front, to remember the no-brainer label is just the article's hook.
Absolutely. All investing has risks. This is one perspective, one point in time.
You really need to do your own homework, consider your own situation, your own tolerance for risk before jumping into any of these. Or any stock, really.
Couldn't agree more. This deep dive was about unpacking the arguments presented in that article, giving you the reasoning. It's just a starting point for your own thinking.
Definitely.
So we've explored the why behind these three picks. Hopefully you have a clearer sense now of the factors the article sees driving ExxonMobil, Enterprise Products Partners, and Cameco.
It's a complex energy world out there, constantly changing.
It really is. And these companies touch on different parts of it: ongoing fossil fuel demand, vital transport infrastructure, the potential nuclear comeback. Think about what parts of that landscape make sense for you, for your goals.
And what level of risk feels right.
Exactly. So this conversation is just the beginning. What other questions does this bring up for you? Are there other sources you'd look at to get a fuller picture, something to think about as you continue your own research?